really did get us on the right path, and we ended up with a surplus that we have really not seen since the tech and telecom bust. We actually think we will see one. It may not be in this during this administration, but the wheels in motion, just like in the 90s, we think will carry forward. The momentum will carry forward.
Hey guys, welcome to Everyday Finance. With an estimated growth rate of negative 2.4% as of March 6th, 2025, a slight improvement from negative 2.8% on March 3rd. The Federal Reserve Bank of Atlanta's GDP Now model predicts a contraction in U.S. real GDP for the first quarter of 2025. Trade tensions, new tariffs on important trading partners, a drop in manufacturing sentiment, and a slowdown in consumer spending are some of the main causes of this pessimistic forecast. The GDP has also been adversely affected by a spike in imports, which is probably the result of companies building up their inventories in anticipation of tariffs. A slowdown in the economy is indicated by U.S. manufacturers reporting declines in employment and new orders. Indicating stagnation, the ISM manufacturing PMI has also fallen to 50.3. Higher tariffs, according to experts, may cause inflation, which could force the Fed to raise interest rates and have an impact on consumer spending and investment. But according to ARK Invest CEO Cathie Wood, these worries won't last long. Although she believes that the U.S. economy has been in a rolling recession since 2022, she anticipates that things will gradually improve and end in the upcoming weeks. According to Wood, the emphasis will change in 2025 to tax cuts, deregulation, higher productivity, and a thriving economy, which will result in a more positive outlook for GDP growth in the years to come. Watch the video.
This is what many economists are focused on, the deficit as a percent of nominal GDP. It is close to 8%, and you can see the little X up near 2.5%, 3%. That is Treasury Secretary's goal over the next 4 years. And with the help of Doge and all the cabinet heads now that Trump has called them to help with the streamlining, we think the deficit will get there because of measures that the government is taking now, and because we do believe that tax cuts and deregulation are going to turbocharge nominal GDP growth. The best way to grow out of a deficit, as Reagan did, or at least started the process in the early 80s, is to grow at an accelerated rate with increasing productivity. And as you can see in the early 90s, through 2000, the combination of the Clinton administration and the Gingrich Congress really did get us on the right path, and we ended up with a surplus that we have really not seen since the tech and telecom bust. We actually think we will see one. It may not be in this during this administration, but the wheels in motion, just like in the 90s, we think will carry forward. The momentum will carry forward. On the next chart, again illustrating tariffs, that was the source of government income in the early days of this country. And as you can see, the income tax and corporate tax rates did not come into existence until the early 1900s, nor did the Fed. And you can see the trade-off that's taken place. We think that President Trump is thinking about bringing back a little bit more of balance here. We'll see if he's able to accomplish it. But I think, importantly, we'll need those tax rate cuts to offset the deleterious impact of tariffs. Now, many countries will offset tariffs by devaluing their own currencies, meaning the purchasing power of the dollar goes up. That's certainly what China did in the first Trump administration. So we'll see what happens there. Okay, on to monetary policy. We've shown you this this chart for quite some time. Money growth is 3.9% on a year-over-year basis. That's in the purple there. It had been negative, and monetary policy works with lags. That's why we put the green line, which is inflation. We've lagged it relative to, or I should say, pushed ahead the money growth numbers. And as you can see, there's a little bit of consternation that inflation has not continued down to the 2% area or less. As you also know, we expect it to do so. The burden of proof is on us, to be sure. I think there has been a lot of pricing behavior recently as companies anticipate tariffs as part of their input costs and are trying to get ahead of it. But we think the resolution will be to the downside here, sort of following what money did. And one of the reasons our conviction about this has grown is the velocity of money, or the rate at which it turns over, is starting to roll over. When the velocity of money is moving up, people are confident, they're willing to let go of their money, splurge a little. That tends to turbocharge whatever monetary growth is out there. When the velocity of money turns down, then that detracts from the money growth out there.
According to Cathie Wood, the current tariff debate is a component of a larger plan to enact tax cuts akin to those that were implemented during Trump's first term, specifically the 2017 Tax Cuts and Jobs Act, which reduced corporate tax rates from 35% to 21%. This action increased the competitiveness of American companies abroad. Trump has consistently advocated for additional tax cuts, particularly for individuals. According to Cathie, Trump's emphasis on tariffs may be a means of raising money for the government, which could then be used as leverage to support tax cuts without widening the deficit. She sees this as a component of Trump's long-term plan to make the American tax system more competitive and growth-oriented. Cathie highlights that this approach goes beyond policy in order to restore economic confidence, or animal spirits, a spike in optimism that stimulates spending, investment, and financial risk-taking. Reduced tax rates would enable people and companies to keep more of their profits, which would boost hiring, consumer spending, and stock market performance. A self-reinforcing cycle of economic growth, propelled by optimism and investment, may result from this. Let's watch further clips.
I talk about small business, just like to put up this chart. Look at how difficult the world has been for small business since COVID. If there's any one part of the market that is due for a reversion to the mean move, thanks to deregulation and tax cuts and animal spirits, it is this one. And so we're pretty excited about what the next few years are going to hold for smaller businesses. You can see, interestingly, you go back into the mid-90s. I remember this period very well. Commodity prices took off in the early 90s, really hurting small businesses. And then in the mid-90s, began the tech and telecom revolution, productivity gains, tax cuts, and I think we're going back to the future in the next few years. And then we'll just focus on a few market indicators now. You can see the yield curve here. The yield curve was negative for quite a time. It's turned positive, but not convincingly so. And I think we reached 35, 40 basis points in terms of positive yield curve, where I think back down to 20, 25 basis points. And inverted yield curves have tended to be harbingers of recession. You can see from the gray shaded areas there, inverted yield curve, then a recession. Well, we've had a rolling recession. And we'll just call it that. Maybe it ends in a formal recession finally, or maybe they backdate the recession, as the National Bureau of Economic Research is wont to do, because they declare a recession years later, typically. Now, yield curves, many people assume we need a strongly positive yield curve with long rates much higher than short rates, which you've seen in certainly since the 80s, since the Reagan Revolution. But if you look back even further, late 1800s, early 1900s, you'll see that we had an inverted yield curve during that period, most of the time, with the average being about 100 basis points. And you can see at the extreme, we got to almost 500 basis points. Why was that? We think it was because well, first of all, we had the gold standard. So there was a price rule. And we think Bitcoin provides the equivalent of a rules-based monetary system, like Bretton Woods did, challenging fiat currencies every step of the way. Not quite the same thing. But the other thing going on back then was massive innovation. Telephone, electricity, internal combustion engine, which led to, automobile, airplanes, and so forth, trains. So lots of innovation, people coming off the farm. And so the short-term yields would move up with the economy, but the long-term yields were much more focused on inflation. And so they stayed pretty low. And in fact, I believe the average back then, over that time period, over the 50 years ended in the Great Depression, was 3.8% on the long bond yield. Even though we were in a booming economy thanks to new technologies, we would not be surprised to see the same this time as well. I'll just go through a few other charts to reinforce what we've been saying over time. Yeah, commodity prices have had a little bit of a bump here. You have oil coming down, others going up, copper in particular, but still have hardly moved in the context of history. We're still where we were in the early 80s, the early 90s, the early 2000s. And then you can see that one of the reasons is the dollar's been going up. A lot of people are talking about tariffs really taking the dollar down because of fears about economic growth and recession. You can see in context what has happened here. Yes, we've had about, I'm going to say, almost a 5% decline in the dollar, but you can see in the context of history, it is still at the stronger end of a range that's been in place since 1990. And very importantly on this next chart, in taking metals relative to gold, the metals price relative to gold, in the purple line here, we're back where we've been during recessions. And the interest rate, however, has not behaved as it has historically. Interest rates have just hung in there. We're beginning to believe that the interest rate will crack now. and that will help housing, and that will be the start of maybe a rolling recovery. But if we're right and the tax cuts and deregulation unleash these so-called animal spirits, it's going to be much more than a rolling recovery. It's going to be a productivity-led boom.
Cathie Wood's perspective on the US economy differs from that of mainstream analysts who concentrate on issues like recession, inflation, and tariffs. She thinks that these problems are already going away and looks forward to an economic future fueled by deregulation, tax cuts, and technological advancements. Cathie is especially hopeful about deregulation, claiming that fewer red tape barriers will encourage corporate investment, particularly in sectors like biotechnology, clean energy, and artificial intelligence. She thinks that, like in the early years of his first term, the Trump administration would place a higher priority on reducing regulations to encourage entrepreneurship. Cathie also emphasizes how innovation in technology can increase productivity. According to her, developments in automation, robotics, and artificial intelligence are crucial for boosting productivity and cutting expenses. She contends that these developments will offset disruptions from trade policies or geopolitical instability by reducing inflationary pressures and boosting economic output. Cathie believes that deregulation, technological advancement, and reduced taxes will all contribute to robust economic growth in the upcoming years, indicating a radical change in the American economy. In contrast to many economists' gloomy forecasts of stagnation or protracted uncertainty, she sees this economic recovery as inevitable. Thank you for watching.